Most traders lose money not because they can't read charts, but because they ignore two invisible walls that control every single price move in the market: support and resistance. They sound simple. They're simple. And that's exactly why most people get them completely wrong. Here's the core idea. Price doesn't move randomly. It moves in memory. Every level where a ton of buyers or sellers traded in the past becomes a battlefield the next time price returns. Think about it this way. Imagine you bought Bitcoin at $42,000, watched it crash to $38,000, and finally saw it crawl back to 42. What do you do the moment you're back to break even? You sell. You get out. So does every other trader who was trapped at that level. That's resistance. The market remembers where the pain was. Support works the same way in reverse. A level where buyers stepped in aggressively once tends to attract buyers again. Not because of magic. Because the same psychology that drove the original trade is still alive in the market's collective memory. Price hits 28,000, bounces hard, and every trader who missed that move sets a limit order right back at 28,000 for next time. But here's what nobody tells you about these levels. They're not lines. They're zones. Treating support and resistance as a single perfect price is how traders get stopped out over and over. The smart money doesn't respect your exact number. It respects a range. Draw a zone, not a line, and suddenly the market starts making a lot more sense. Now, trading the bounce. When price approaches a strong support zone and you see the candles slow down, wicks starting to form, volume dropping on the sell-off, that's price testing the level with less conviction. The bounce traders are loading up. The setup isn't when price touches the zone. The setup is when price rejects it, closes back above it, and confirms the level is still holding. That confirmation is everything. Breaking through is a completely different game. When price smashes through a support level with force, high volume, and closes convincingly below, that support just flipped to resistance. This is called a role reversal, and it's one of the most reliable concepts in technical analysis. The old floor becomes the new ceiling. Traders who bought at that level are now underwater and will sell the moment price returns to their entry. That returning price, retesting the broken level from below, that's your short entry. The discipline to wait for these confirmations instead of jumping in early is what separates systematic traders from gamblers. You don't chase. You define the level, you define the confirmation, and you act on evidence, not emotion. That systematic approach is exactly what Vishmaster automates at vishmaster.live.